you've heard from my fellow speakers what a pension is and how you build up money in a pension, how it's treated tax-wise while the plan is continuing to grow. Up to the point where you want to take your money out. And this is technically referred to by those in the industry as drawdown, or drawing your pension benefits. Before I do that, though, there's two things that I want to say which I think are really important. The first is that there's no one-size-fits-all solution for taking money out of a pension. It depends on a whole host of factors, including how much you built up, what your goals are in retirement, how much you value a known income, all of which are personal to you. That's nobody else's business, that's just for you. You may hear talking about people saying, oh, I did this with my pension, or I did that with my pension. Just because they did it doesn't necessarily mean that it's right for you. And the second is related to that, and it's the importance of talking it through with a financial advisor first before you start taking any action. And they may expect me to say that, given that I work for a financial advice firm, but it's the fact that talking it through with a financial advisor will help you see all of your options and agree something that's right, as I said, for you. Because in most cases, once you've made that decision with a pension, it can be difficult, if sometimes impossible, to reverse it. So, sorry, on that rather dramatic point, let's move on. So, I said every pension has two parts to it. It's available from age 50 or 55, depending on various factors such as UK. Oh man, I won't go into too many of those. It's a bit too, I won't say too early, but too late in the day to go into all that. The first element is tax-free, and it's officially called a pension commencement lump sum, or PCLS, rather technical term, but it's actually more commonly referred to as tax-free cash you can take from your pension. And this must always be taken first, or you lose the entitlement to do it. So when you first take money out, you have to take the tax-free bit first, otherwise you can't take it again in the future. If the pension is defined contribution, which you've heard before, i.e. how much you put in plus the investment growth, determines what value of pension pot you have when you reach retirement. The tax-free portion could be 25%, 30%, 40%, nice and simple, depending on which type of plan you have. If your pension is a defined benefit, so as in there's a promise from your employer or the government, or whoever that may be, to give you a set level of income at retirement, typically this isn't done by a percentage, this is done by you exchange. You say, I will give up £1 for every £12. So you get £12 for every £1 that you give up, or £15 for every £1 you give up, in some ways. But every scheme is different. The remainder of your pension, I've gone through all that, is taxable. So everything you take above that initial tax-free lump sum will be taxable at whatever marginal rate, whether that's 10%, 20%, or depending on your income, you may not pay tax on it at all if it's at that lower level. So, the types of pension income there are. Now, I have to apologise because this is all very, very general. So, as much as I've said that there are defined contributions, there are defined benefits, those are the very general terms. There are, I wouldn't say 1,000,001, there probably aren't that many, but there are myriad types of different pension arrangements. So, if you've particularly older pensions, it's always best to speak to an advisor because they'll all be slightly different. So, having looked at the two parts of a pension, we now look at how the pension income is paid to you. So, there are four main ways in which money can be taken in the Isle of Man. And these can be split into either fixed or flexible pension income. So the types of fixed income that you'll get typically are a scheme pension. So these are typically from a final salary arrangement, such as you get with the Isle of Man government, or an annuity, which I know in the industry we're trying to move away from that term. It's more commonly a fixed income for life. So rather than it's so much either a month or a year, which will either be fixed or it'll be inflation linked for the rest of your life. And then there are two types of flexible pension income. These are either income drawdown, which we've heard from a SIP, self-invested personal pension, and the pension freedom scheme, which I haven't gone into too much detail because it is something that's quite new, it's subject to change, but I will cover it very briefly later on, mostly because a lot of people don't have them at the minute, because it's only very new, only introduced in April this year. Now I'll briefly look at each of these in turn. So the vast majority of scheme pensions, as they are, or defined benefit final salary arrangements, these, as noted, Sharon knows earlier, are linked to an employer, such as the Isle of Man government, some of the larger banks, insurance companies, etc. These have hit the headlines of late with people transferring their pensions out into personal arrangements, but and the income that they're provided is very generous. But it's always well, in the UK, from UK schemes, it's a requirement. You have to seek financial advice. Anything like that, it's a very, very serious thing to do. So you really should talk to someone before you make that major choice if you were looking at transferring it. And the payment's made monthly or annually, usually increasing with inflation, and most of them have some sort of spouse, partner pension built in, and some will guarantee to pay it, say, for the first 5 years in the event of your death in that period. It's paid by the pension scheme trustees, and it will last, providing the employer stays around, for the rest of your life. An annuity is a fixed income with a defined contribution pension. It also comes from a final salary, but I won't go into that. Generally from a defined contribution scheme. And annuities, or fixed incomes, for the rest of your life, be paid monthly or annually and will also continue till death. There's the option, in this case, rather than the right, to have the increases, have it increased with the cost of, with inflation, or a percentage paid to your spouse or partner. However, rather than paid from the big pot of money that the employer or government has, it's usually you say to Mr. Aviva, Mr. Zurich, Mr. Prudential, here's my pot of money, what will you give me for the rest of my life in exchange for this sum of money? So say £100,000, how much will you give me for that? Then they'll quote an amount in which, present rates, it could be around £5,000 a year. That's obviously that's subject to change, but roughly that can be what it is. Both of these fixed income pension types would suit people who like to know that exactly how much they're going to get from their pension each month, each year. So if that's important to you, that may be something you want to consider. And they're not the sort of people that they're not really very keen on monitoring their investments on within their pension every year. They just want to say, how much am I going to get in? And again, that might be something that you value. Others may have different views. There's no right or wrong answer. And then the second type are flexible income pensions. As the name suggests, these don't pay a fixed amount, and the amount that you can take can vary greatly from one year to the next. Prior to the budget in 2018, in the Isle of Man, there was only one option for non-fixed income, and that was income drawdown. This is only available for defined contribution plans, so it's not something that's linked to an employer. And unlike the UK, you need to take out, in the Isle of Man, a self-invested personal pension in order to do that. And these are much more complicated than an annuity or anything like that, and there are higher costs associated with running it on an ongoing basis. But when you come to take your money out, there's much greater flexibility in how much or little you want to take out. You can vary the income limits from one year to the next, and it comes out as a series of lump sums rather than a fixed amount. You can decide how much you want to take. And you can't. There's the choice. You can take your tax-free lump sum and then not take anything until age 75 if you wanted to. But a key difference to annuity is that income drawdown is in effect taking chunks. So the rest of your pension will be invested in the stock market until you take it all out, and there is the risk that you will run out of money. So we have to say that sustainability of income is one of the key issues that we're all having to face, which Sharon picked up on before, about making sure you've got enough left to last the rest of your life so the pot doesn't run out. And actually, very briefly, I'll talk about the Pension Freedom Scheme. I'll only touch this briefly just because so few people have them at the minute. But this is a defined contribution plan, same as a SIP, and an individual can only at the present time have one at once. And it's most likely after a transfer in, so you move your pension from somewhere to another type of pension. And the tax-free portion is slightly higher, which is 40%. But if you want to transfer your money in, the government currently charge an amount, 10% of the value of the transfer in, as a levy. But you cannot take in stages. 40%, unlike with the income drawdown, you can take as little, so this tax-free portion, you can just take little bits of it. With the Pension Freedom Scheme, you have to take 40% of the value up front. There's no choice. And then the rest, little or as much as you want, whenever you want to take it. Because with income drawdown, the pension provider will generally set limits on how much the trustees feel is safe for you to take out. Pension Freedom Scheme, however much you want. You can take the whole lot in one lump sum if you want, or you can take it a bit more sustainable, or just take a chunk every now and again. But the important point with both of these is that, as I said, it is possible to run out of money. And hopefully with working with a financial advisor, that won't happen, but it's just being aware of that before you go onto that journey. So I think that's everything I say. That is very general, so it's always best to talk to a financial advisor, particularly some of the older schemes. They are a bit weird and wonderful.